practical, you get marks. Are we clear? So I've calculated very practical set of ratios, yes, right? So cost increase, so out of total cost, you can do the same thing for cost. Out of total cost, 23,000 is my household goods. There you go. Now let's do the discussion. Let's do the discussion. Okay, now one second. Yeah? One second. Changes. Yeah. Year on year, GP based ratios, expenditure based ratios. Yeah, yeah. Now, okay. Once you calculate your ratios, people, since prices have remained, total revenue also, okay, okay, right. People, now what can we say about the increases, decreases? What can we say? Operating profit ratio can be calculated? Yes, you can. Yeah, yeah. You can calculate. No, no, no harm. Yes. Guys, now my point is, a lot of ratios can be calculated. Now, let's see what we can say from these ratios. Right now, I haven't calculated, like, the answers. I haven't, done the ratio as full, but, can say definitely, right? We can say something about the ratios that we are calculating. People, now for example, let me talk about the notable increases, decreases. Okay. They say worldwide electronic goods market, it has grown by 20%. Okay, my sales have grown by 28%. So I have beaten the worldwide growth rate. People, when they talk about, like, these, they they're talking about certain aspects, certain things relating to their product portfolio, right? So CF, right? So they're talking about global growth rates. Now, even in ACCA, people, you have global pass rates, and we have our own pass rates at PBIM, right? Like that only. So here, worldwide growth of electronic goods market 20%. Your sales have grown by 28%. Right? So you've beaten, you're basically surpassed worldwide averages. Brilliant, solid, right? Okay, so you have gross profit margins, so you need to calculate gross profit margins. Electronic goods, people, I'm sure gross profit margin is improved. Why is that? Because you're getting down, sorry, electronic goods. No, no, no. Yeah, electronic goods, solid. Then what about household goods? Household goods, the ratio has come down, no? Right? Revenue has come down. I don't know, people, it could be 5%. I'm just like, I've calculated the values very fast. I don't know whether I've made any errors. It has come down. Why do you think it has come down? What could be the reason? People, they say that you're getting these goods from a cheap, from a country that has cheap labor, right? A cheap labor means cost of supplies are low. That's good, brilliant, right? The sales may have gone down, maybe because the quality of household goods that they have gotten from that country slab is of low quality. So people are not buying. Yeah. Also, people, you can connect that to customer complaints. Customer complaints have risen like exponentially. There's a massive increase in customer complaints. You can link that to, this decrease in household revenue. So you're saying, you're getting cheap supplies. Maybe that is the reason why revenue from households have gone down, and that could have contributed to the increase in Right. Then you can talk about cloud computing services. People, do you see now? You don't have to like have ratios to talk about this. When you look at this financial statements, when you look at this data, you should see things. Look at the increase value. 6,520 last year to 12,400, almost 100%. Yeah. So we calculated the increase, 90% increase. They say, look here, they tell you that average growth rate for cloud computing have been 50. Your growth rate has been 90. Again, you have surpassed global rates. Solid, brilliant. So what does that tell you? You need to focus more on electronic and cloud computing because you have beaten worldwide growth rates. Yeah. People they talk about gross profit margin, right? Average growth rates and gross profit margin. So you definitely have to calculate gross profits, right? So you might be able to complement. Okay. So cloud computing people, I'm sure there is a massive gross profit margin. Yeah, there is a massive gross profit margin. From cloud. Talk about it. Say that okay. Let's go in cloud, right? What about this gold membership thing? People, so this is your next day delivery thing. Next day delivery thing, I think, has epically failed, right? Why is that? Because they tell you that percentage of orders delivered on time from 92 last year, it has come down to 74 this. It has come down to 74 this year. So you're not delivering on time, meaning your logistic company is well, it sucks. Let me put it that way. It sucks. You have, you know, formed your own logistics company instead of using services of international delivery companies like DHL, FedEx. So you're not using them. You have formed your own logistics company. Obviously, you're not going to have that global reach that these companies have. So no wonder that your gold membership fee has come down. So people are not happy with it, right? I am pretty sure that could also be a reason for this increased number of complaints. When you expect something tomorrow, right? I mean, you see next day delivery, order that. People to get that next day delivery thing, I think you need to pay something, some membership fees there. Yeah. So you have paid that, and you're not receiving the goods on time. So you're thoroughly unhappy. You're so unhappy, right? You start complaining like hell. There you go, people. Now, I'm just showing you that there are so many things for you to applicate, right? What else? So administration cost increase, people. That's just that's not normal. See, from 1,700 to 2,000 people, usually admin expenses they stay the same, right? Admin expenses of any company they stay the same, right? More or less. Marginal increase like 1%, 2%, up or down. Here it has increased by thousand. See, from 1,007 to 2,007, 1,000. It's a massive increase. Why is that? Because of your customer services, whatever department, they're dealing with customer complaints. So I'm sure they're getting a lot of complaints from those people who ordered goods and not receive them on time, and also people who purchase these household goods. Are we clear? Number of customers, it has risen, right? But you can say because of this poor delivery, because of the low quality service, customer numbers can fall into the future, right? Percentage of late goal member deliveries. Look at this. Late deliveries last year was 2%, this year 14%. This tells you that you have to close your logistics hub, close it down, and use international delivery partners. So many things for you to talk about, right? So many things are there for you to talk about. Any questions? Any questions? Let me show you my sample answer now. There you go. This is my sample answer, right? Increases, decreases. Now in my, in the calculation that I did on that Excel sheet, I have more ratios, right? People, you look at the examiner's answer, you see some set of ratios. You will have either more or less ratios than the examiner's answer. As long as your ratios can, like, tell a story, people will get marks. Are we clear? So how do you figure out what type of ratios to calculate? How do you figure that out? People, you need to look for information in the case study, right? You need to look for information. Get this. You need to look for information. Now here, they talk about growth rates now. Growth rate, right? So, calculate the year-on-year increases whenever they talk about growth. Gross profit margin, they talk about gross profit margin to calculate gross profit margin. Yeah, net profit margin, operating profit, whatever. Right? Uh, you know, and this is a pretty basic question, people. The reason why I selected this is here you have a lot of non-standard ratio. Okay, non-standard. People, now you may have calculated like a lot of ratios like this. Maximum mark that you're going to get is 7. Okay, maximum is 7. The rest is your discussion. So discussion, you need to, like, don't state the obvious, people. Now, for example, my household goods sales have come down by 5.27, right? Why is it coming down? You say this could be because of the low quality supplies that you're getting from Slovak. It can be assumed that because the labor is cheap, the ultimate product is of low quality. There you go. See, one small part. And you can say this could have also contributed to the increase in customer complaints. Right? Customer complaints have risen exponentially. Yeah. See, one by one, you start talking about things. Are we clear? Are we clear, people? Are we clear? Any questions? Any questions? Any questions? Anyone? Gayatri, any questions? How did you, like? How many ratios did you calculate? How many? At least like 6 to 7 ratios. We gave you like more than 20 minutes. Yeah. So people, as you read, you have to like start living in the question. Cheap labor meaning low quality supplies. So blah blah. Cloud computing is your star product because your revenue is up by more than 100%. For sure, close to 90%. 90. So cloud computing is your star product. You have to say, okay, the company has to invest more on cloud, right, and more on electronics because they have surpassed global rates. Gold membership, throw it away, close the factory down, make recommendations, right? Make recommendations. Are we clear? And also, guys, you can say, here, if there were more information, I could have calculated more ratios and come up with a better analysis. So due to lack of data, the analysis is somewhat limited. You finish your answer that way. You get it? Are we clear, people? Any questions? Any questions? We don't have to put all the ratios. Abdul, what do you mean put all the ratios? No, you have to. I simply didn't calculate this because these are pretty basic. You can calculate them on your own, right? I am more interested about telling the story that these figures indicate. Okay. Any questions, people? So company performance analytics, not a big deal at all. people, remember, you will have to calculate some ratios and focus more on the discussion. Ratio analysis, people, unlikely. Like, it's easy, but we never know. Are we clear? Are we clear, people? I'll share my sample answer. Later I'll attach that, to this itself, or maybe I'll attach a sample answer to this and erase all these. Yeah. Okay. So this is the performance analytics of companies. Are we clear? You do one more question, people. That should be enough. One more. Right? You have other sections. People. I didn't plug any, of those questions into the paper because it's pretty basic. Like, you know these ratios even from your A-level solvers if you've done comps, even from your FA module, like MA module, you've been exposed to these. So not a big deal. Right now, we'll look at the performance analysis of divisions. Any questions, people? Any questions from performance analytics of companies? It's all about getting the story. Okay. So there is a disturbance. Can you hear me clearly? People, can you all hear me? Okay. That's all. Please tell me that heard some of the things that, at least some of the things that I talked about. Yeah. Sometimes it's not. Right. I've switched off Gayatri. Right. So telling the story is what is important in ratio analysis, people. Remember, you can calculate any number of ratios, right? So 7 marks now, 7 marks, yeah. You can calculate 20 ratios, right? 10 ratios, 5 ratios. The more the better, right? But don't waste a lot of time. Yeah, you need to tell the story. Do not state the obvious. Now, I never said electronic goods, increase from last year has been 28.3. No, I don't have to say that. You have to say why this has happened. Why? Always talk about the why. Yeah. Connect. So I connected my gold membership to customer complaints, household goods to customer complaints. Yeah. I talked about this distribution cost. So distribution cost, there is no major increase or decrease, so don't talk about it. No point. I talk about the major increases, like major increases or decreases. Okay. See, people, that's why I didn't want to calculate gross profit margin and all that, right? No major increase, no. See, from 82 to 94. But here, obviously, when your revenue is coming from like different streams, you need to do the analysis for the streams individually, not focus more on the total value, right? Do it for the individual revenue streams. Are we clear? Right. Okay. Now let's look at a question on performance analysis of companies. Right. Okay, people. Now divisional performance analysis. Very, very important. Very, very easy. People, this can be tested in your section C. If you get a question on section C, people, you're golden. You're golden. Most of the time, divisional performance can be linked to transfer pricing as well. Transfer pricing, that is a bit of a complicated area. So I have, kept the complicated ones, the hardest one for our last class. Yeah. So in our last class, what I'm going to look at is our variance analysis and transfer pricing. Only those two. Yeah. 2 questions from transfer pricing, 2 from variance analysis. The others, pretty basic, people. Right. Okay. So remember, when you analyze the performance of a division, you're basically analyzing the performance of the manager. Right. So when you analyze the performance of the manager, you have to remember, you have to consider only controllable revenues and controllable profits. Yeah. So if there are uncontrollable costs, uncontrollable revenues, you need to remove them from your divisional performance evaluation because it's not fair. Let's say you're managing a division, right? The boss is telling you, look here, take some of my depreciation, right? I want you to put 400, I want you to take 400 of my depreciation. Now, you take that depreciation, people, your divisional profit is going to come down, right? So that can happen. That happens. You can't prevent, things like that from happening. It's very normal. But if the boss is evaluating your performance with that 400 depreciation, that is wrong because you can't control it. You have to remove it, right? Only controllable things can be included into the divisional performance analysis. Are we clear? So how do we calculate the divisional performance, people? There are two main methods, ROI and RI. ROI, this is your ROCE, right? Profit divided by capital employed. Here we are calculating the ROI or ROCE for the division. So you have to look at the profit related to the division, right? So profit related to the division, that profit should be the controllable profit. Uncontrollable things should be deducted, should be removed. Same applies to capital employed. Yeah, ROI is very simple. Then you have RI. How do you calculate RI? So ROI is this. RI, we say it's my RI is controllable profit minus notional interest on capital. There you go. Yes. So how do you calculate notional interest on capital? Notional interest on capital is uh, capital employed. Write that here. Capital employed into right? Are there? Okay, so here you have you have a hell of a lot to read, right? And then answer these questions. But we look at firstly is the requirement. Okay, calculate ROI for each of the two divisions. Discuss performance of the two divisions, including the main reasons why the ROI results differ from each other. Explain the impact the ROI could have on behavior of the manager. All right. Okay. Part B, calculate ROI. Right. People, I want you to calculate ROI and RI. We'll talk about the rest. Right. I want you to do the calculation on your own. Right. Read the case study. Right. I'll give you 20 minutes. Read the case study. Quickly answer this. 20, yeah? 20 minutes. Right. People, shall we go through the answer? Right. Now look here. Guys, can you all hear me clearly? I switched on my fan, but I moved it away from the place where I'm sitting. Can you all hear me clearly? Can? No, still no. Right, okay. Right, thanks. Right, okay. Let's see. Calculate the ROI, not a big deal, right? Let's see. So you're looking at what? Two divisions, photographic and optometry. So P&O. Each division is run by a division manager who has overall responsibility for all the aspects of running the division. So there are four types of divisions of people: cost divisions, revenue divisions, profit, and investment. So in PM, we talk about only investment divisions. Investment division manager has to bear costs. He is going to see revenue. He's going to have profits, and also he's going to make investment decisions, right? Divisions are currently treated as investment centers. Each manager has an authorization limit of 15,000, blah, blah, blah. Head office made the decision to sell a large amount of equipment. Board divisions trade with overseas customers, right? Cost of capital is 12%, right? Okay. Actually, guys, if I'm not mistaken, we did this in class the other day, right? I don't know whether you were there. We actually did this in class, but that's okay. Some of you may not have attended that. Anyway, so there are people who are here who don't follow my classes. So anyway, let's go through this. So here people, they say 12% per annum is cost of capital. Board divisions trade with overseas customers, choosing to provide, yeah. That was a different question. Okay. Choosing to provide blah, 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 60 days credit. Okay. So head office is making a decision now. I need to highlight these. Right. Head office made a decision. Sell large amount of equipment, right, in division P. So whatever the profit that you're getting, not relevant, as in, it can't be controlled, right? It's arising because of the head office, not because you made that decision. Yes, so you need to remove this. It also decided to close one of division O's factories. Okay. So whatever costs and revenues related to this factory related to division O, again, should not be considered, people. Why? Because head office is the one who's making that decision. Yeah, head office is the one who's making that decision. Okay. Yeah, I thought this. Anyway, I think it's the same question. Yeah, same question. That's okay. That's fine. So there's another question. So this is the only question that I could find where they ask both ROI and RI, right? In some questions, they ask only ROI, not RI, right? Anyway, do some calculations, people. Not a difficult area, right? These are not difficult areas. That's why I'm not put more questions. This isn't it sports company? Oh, that was sports company. I can't remember. Sports. Efficiency. Yes, Yumna. It was sports company. Right. Okay, we haven't looked at this, so good. It's good that I'm looking at this now. Right. Okay. Lens. Blah blah blah. Let's see. So now you have all these values. Depreciation on uncontrollable assets. Blah blah blah. Calculate ROI for each division. Now ROI, people, controllable profit over capital employed. Right, let's see. Controllable profit of division P. So you have to take definitely this 14,000. Gain on equipment, you don't take it because this is arising because of the head office. You didn't sell any equipment, head office did. Direct labor, you definitely have to take that into account, right? Okay. Direct material, Sorry. Oops, sorry. So I'll, highlight in green whatever the things that we. Right. Okay, so they in sports also they ask both ROI and RI. Yeah, no. Okay. Good. I thought it was just ROI. Maybe in the question that I selected for you, it was just ROI. Wait, I selected another question for you guys. Performance. Wait. People, we are doing lens, not the sports, right? We are looking at lens, not sports, This one. This is what I wanted you to do, not sports. Lens. We never did this, no? I don't think we did this in class. What was it sport? People, what did I ask you to do? Was it sports or sports or lens? What did we do in class? What was it that we did? I did for sports. Right. Okay. We did lens in class. Okay. Cool. Right. Okay. We did lens. Yeah, we did lens. Yes. Abdul, Yumna, both are telling me that we have done lens. So let's not do lens. We'll do sports. Right. So I've been reading the wrong question, although, sports. Right. Let's see. Sports. Right. Okay. Sports company, large manufacturing company, blah, 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 clothing division C, equipment division. Okay. Each division operates with little intervention. Brilliant. Sports company measures the performance of its division using ROI. So this is their principle, performance measurement or the metric. Target ROI. There's a target ROI. Target ROI for each divisions 18%. So there are two divisions, division C and division E, right? Okay. Last year, an investment which is expected to meet target ROI was rejected by so investment rejected by one of the divisional managers because it would reduce divisional overall ROI. Consequently, sports companies considering the introduction of new performance measure RI. People, we know ROI has a major problem. No, what is that problem? It makes the managers selfish. Yeah, managers become selfish because of ROI. Are we clear? ROI is a percentage. So ROI is directly linked to their bonus. If the ROI decreases or if the new investment is not achieving that target ROI, you cancel it. Sometimes managers end up canceling even good projects, really good projects, right? So how do you make the investment decision when you use ROI? You compare the ROI against the cost of capital, no? Right, okay. Blah, blah, blah. So you have this thing. Sales, contribution, opening divisional controllable assets, closing division, right? So people here, they are giving you opening and closing. So you need to get the average, right? You have to get the average. Please understand that. Yeah. They're giving you opening, closing, add them up, divided by 2. That's your capital employed, right? Included in the fixed cost are depreciation cost of 165 and 464 division C and E respectively. 30% of depreciation in each division relates to assets controlled but not owned by the head office. So assets control. So 30% of 165, 460, you have to take it into your calculation. Isn't that the case? 70%, I don't know people, let's see. 30% of your depreciation, right? 165 into 30%, That is depreciation relating to each division, no? Yeah. So you have to take 30% of 165, 30% of 460. That's your depreciation. Division E, invested 2 million in plant and machinery at the beginning of the year, which is included in the net asset figure. Division E. So 2 million is there in this. They are using reducing balance. Okay. Division C, which uses straight line method, made no significant additions to non-current assets. It is the policy of both divisions to charge full year's depreciation in the year of acquisition. So this is accounting stuff now, right? So even if you buy in the middle of the year, people, you still have to charge the full year depreciation. That's a no big deal. That's not a big deal at all, right? Okay. Head office recharges all of its cost to do divisions. These have been included in the fixed cost. 620 for division C. What's the fixed cost? Oh, right. So from 945, you need to minus 620. And C 700 from this 1420, you need to minus 700. Right? What a joke, people. So simple. First one, calculate ROI. Okay. So you take the net profit, right? From that, right, from this net profit, you need to minus, well, you need to add this depreciation charge in full, 165, right? And then minus 30%, no? Do you understand that? Right? You add the full depreciation. Okay. So, 1,004, you're working with net profit, right? So net profit of division C is this, add depreciation. So guys, now what do they say? Add depreciation, wait, 30% of depreciation cost in each division included in fixed costs are depreciation costs, right? 30% of the depreciation relates to assets control but not own. Oh gosh. Here, oh my God, people. 30%, I think I read this wrong, no? People, 30% of depreciation in each division relates to assets controlled but not owned. Controlled by the division? No, yeah, 30%. You need to, so that's the depreciation charge, in other words, people. Does that make sense? See, 165 into 0.3, no? Yes? Are we clear? Do you get it? People, so you can get the answer in this way as well. So I'll say division C. Division C. Total profit, how much? Net profit is 1,455. No? Net profit 1,455, right? So in this, you have a depreciation of 165. No, you have deducted this, right? Let's add this back. Depreciation, you add 165, right? So now, you know, when you add the depreciation back, it's like there is no depreciation. Yes. To this, from this you minus, right, the depreciation that is relevant to you. What is that? 165 into 30%. No, people, isn't that correct? Depreciation cost in each division relates to assets control but not owned. Yeah, assets control not controlled by, oh my God, people. Assets controlled by the head office. Man, this question is so confusing. This statement is very confusing. Assets controlled by the head office. 30% of depreciation is not relevant to you people. 70% is what is relevant. Yeah. So you need to add back only 30%. That's what I'm showing here. Yeah. Which are, yes. So 70% of, now this statement, guys, it's a bit confusing. See, these are depreciation, 30% of costs relates to assets controlled but not owned by head office. So assets are controlled by the head office, no? So, you can't control it. So depreciation also is not controllable. So you need to add it back. That's why you're adding this depreciation back again, people, right? I read it in the other way, people. I think I misread it. I didn't read it properly. Are we clear? Everyone okay with this? People, I'm sorry if I confused you. I got a bit, I got a little confused. That's what happened, right? What the hell? Right. Okay. So add back your head office, cost 620 and 720, 700. Now, this is my controllable profit. Yes. So what do I do to get the average assets? Add these two, divide by 2. So when I add opening closing 22,000, you divide it by 2, you get 11,000. Same thing here. So ROI 19 and 17. Are we clear? ROI calculation is pretty basic, right? Then, okay, we'll do the RI calculation as well. RI, you have the controllable profit that you have already calculated here, no? Now, from the controllable profit, you need to minus notional interest, no? So notional interest is going to be calculated against your capital employed, right? Average capital employed. So that, there you go, people. So are these your notional interest on capital? So what you do is you take your capital employed, multiply it by the cost of capital. People, what does this cost of capital tell you? What does this mean? 12%. You provide 100 to the company, you need 12% back as a return. That is what this 12% means. Cost of capital. Listed companies are financed by shareholders. No, shareholders, they give money, right? So when they buy shares, it's basically a lending transaction. Yeah. So you give money to the company, but not free of charge. You demand 12% return, meaning for every 100 that you give, you need 12 in return. So in total, you need 100 plus 12, 112. Are we clear? So you have, given how much to this particular division? 11,000. So you need 1,320 as return. That is what this notional interest on capital means. So these are my RI values, people. Are you getting these RI values? Are you getting these RI values, people? Anyone who's confused with the RI values? Anyone who's confused? Yumna, are you clear with the RI calculation? Abdul, Shweb, Gayatri, everyone okay with the RI calculation? Pretty basic, no? Pretty basic, yes. Right. People, so we know when your RI is positive, it means, that means it's good. If your RI is negative, problem. People, look at this. So I'm going to explain this RI, again. So, for the amount of capital you have pumped into the business, you need 1,320. The division is giving you a profit of 2,124. So you're getting much more than what you're asking. You're asking for 1,320, you're getting 2,000, so you have positive returns. Here, it's even higher. Residual income is, this is how much you need, 3,240. The division is generating 4,700. You're getting 1,548 extra. So RI actually tells you the return over and above, right? Over and above the minimum return. This is your minimum return. Do you understand that? Yeah. So you can clearly see that RI of division E is higher, but ROI of division E is lower, ROI of division C is higher. So two methods are providing, conflicting resolutions. No, according to ROI, division C is good. According to RI, division E is good. Does that make sense? Yeah. Now, once you're done with the calculations, what do they say? Explain the advantages, disadvantages. What a joke, right? People, advantages of RI. Let me look at it. RI advantages. It's an absolute value. It's a dollar value, no, right? So people like, now whenever people tell you, okay, this is the return in like monetary terms, you're going to like it more than when they say this is your percentage return. Sometimes people don't understand percentage returns, people, right? When they tell you, okay, look here, your return is 1 million. Wow. Your return is 10%. Huh? What's 10%? You get confused. One of the advantages, it's an absolute value. Second advantage, you're comparing your return against the minimum return required by shareholders, right? So this is like your NPV, people. I know it's not NPV. For it to be an NPV, you need to calculate the discounting factor. You need to calculate present values. Yeah, but this is similar to that NPV, the answer. Disadvantages, it's an absolute value, so you can't compare. ROI, it's a percentage, no, can compare. RI, not comparable. RI, another disadvantage is, it's still based on profit, people. Profit can be manipulated, no? You can make this go up or you can make it go down also. Do you understand that? So RI can be manipulated easily because it's dependent on accounting figures. A major advantage of RI is, unlike ROI, here your manager is not becoming dysfunctional. Your manager doesn't become selfish. Your manager tends to undertake whatever the project as long as your RI is positive. But ROI, not the case, right? So those are the advantages, disadvantages. Part D, what do they say? Discuss the performance of the two divisions, including the main reasons why their ROI results differ from each other. People, why do their ROI values are like different? So target ROI is 18. They have achieved 19. Here, only 70. People, why are the ROIs different? People, one of the major reasons is, ROI of division C. People, do you see that ROI is basically you divide your average assets, sorry, profit by the average assets, no? So if your denominator is high, your ROI is going to come down, yeah? Right? If this is like 12,000, see, ROI comes down. So, now they say that division C has bought new assets. Sorry, division E has bought new assets. Division E invested 2 million. Division C, no significant addition. So division C has not invested anything. They have not bought any assets. That's why average assets are lower, right? And this division has bought new assets. That's why the average assets are higher. That's one reason. One reason for the difference between the ROIs. Are we clear? Here the denominator is very high because they have bought assets. Here denominator is very low. That's because they haven't purchased any asset during the year. Also, people, the depreciation policy. You look at this. So, when you charge depreciation using this reducing balance method, you charge very high depreciation during the first few years, no? You charge a very high depreciation in the first few years, right? I'm sure you understand what I'm talking about. This is accounting, yeah? Yes. So, now we'll talk about those as well. So here, you're looking at depreciation policies. Two different policies, no? Straight line method and reducing balance. People, when you have reducing balance method, you end up charging very high depreciation in the first few years, right? Division E has bought 2 million worth of assets, meaning you're charging very high depreciation. E is the one who's using reducing balance. So therefore, their profit is lower. Division E, Division E's profit is lower. Why? Because they are charging high depreciation compared to the other division. Actually, allocation of fixed cost is not a good point, right? It's you can clearly see that you need to talk about something more, right? You can clearly see that your fixed cost allocation is different, right? That's pretty obvious. Yes, you need to talk about like things that are not very obvious. So what I was just explaining is something that is not very obvious. You need to extract it, right? So depreciation is what you need to talk about. Reducing balance, you charge very high depreciation. So therefore, E is going to have a low profit compared to C. In other words, E is going to have a higher depreciation figure compared to C. Those are the reasons, people. Are we clear? Are we clear? Any questions? Yeah. Okay. So once you talk about those, right, and then they ask you to talk about explain the impact the difference in ROI could have on the behavior. People, see, actually, division, C, even though it has a very high ROI, it's not because of they have made good investments. No, they are showing a high ROI because their assets are lower, profits are higher, right? So division C, even though the ROI is higher, when you look at things in a microscopic way, if you put things under a microscope and look at division C hasn't done anything, right? Division E, right? Its ROI has gone down, right? So does that mean your division E is bad? No, division E is actually good, right? But the good manager, good division, so the divisional manager is going to get discouraged, no? Right? Division E manager should be rewarded, right, for making investments and all that. But because of ROI, he's going to get discouraged. He's like, my bonus. But he or she is the one who did some solid, this manager is the one who has done some solid work, not this manager. But the one who has not done any work, he's the one who's getting all the appreciation. So that is going to discourage, that is going to demotivate this manager. Are we clear? Are we clear, people? That's what you need to talk about. Are we clear? Pretty basic, right? Pretty basic, people. If you get a question on, a divisional performance analysis or company performance analysis, people, you're golden. You're golden. Are we clear? Any questions? Any questions? No? Okay. So people, that's why I said now, try not to state the obvious. Whatever that you can see, don't talk about those a lot. Try to see whether there are more things that are not very obvious, they're hidden. So you need to uncover them. Okay, you need to discover them. Not that difficult, yes. This is purely accounting, people, financial accounting, right? This depreciation thing is completely financial accounting. Are we clear? Any questions, people? Any questions? No? Right. Okay. People now, I've told you the bigger the question, the more the easier it is. Yeah. So when you have a lot of information in a question, don't get discouraged. Don't get scared. Like, don't panic. The more the information, the better it is. Because, tackling the question is going to be easy. Do you understand that? So this is like actually, a lot of information, right? Even the other question that we did in class had a lot of information. The answers were pretty basic. You didn't have to think a lot. Even here, you're looking at the same thing. Are we clear? Right. Okay. Now we look at the next question, people. Uh, this one. We'll do. Let's do. Let's do this one. Performance analysis of service organizations. We'll do this one, people. Yeah. Performance analysis of service-based organization, right? Let's do this one, right? Okay, let's do this together. I'll give you 10 minutes to read and understand whatever that they are telling you. 10 minutes to read, right? Quickly read this. Yeah. Okay. Can we have a look at this? Are you there? Can we look at this paper? Right. Okay. People, now the reason why I have selected this question is because this is on that model, right? That helps companies to evaluate. There are two main models now when it comes to performance analytics models. You have balance scorecard and building block model, right? Okay, so the building block model, like I said before, is used in the service, based industries, right? It's used by service providers. So what is it? It's a model that helps service providing companies to understand their performance. When you say performance, it's always two types, yeah? Financial, non-financial, right? So what is the crux of this building block model, people? Please look at the model. The model is this. You have dimensions, you have standards, and you have rewards. All three are linked to one another, right? So, on top, what you have is dimensions. Dimensions are basically your critical success factors, CSFs, right? Critical success factors. What the hell are those? Right? What do you mean by the critical success factors? People, now, I've always told you, right, in my classes, there's no point going through the handouts. I've always asked you to practice, whatever that's there with questions, right? If you can't remember stuff, you look at the note, right? So how do you go to the note? Through questions, right? You start questions, you start answering, whatever that's there in the question. If you can't remember, that's when you use the note, not the other way around, right? You don't look at the note and the question, no, not like that. So it's a critical success factor. It's so critical that if you do it the right way, it's going to help you to go for a really good mark, right? It's a critical success factor as far as your exams are concerned. So you have to do it. You must do it. If you don't do it, you know, uh, you're not going to get a good result. Are we clear? Dimensions are basically those with respect to service providing organizations. People, are we clear? So service providing organizations have 6 critical success factors according to building block model, right? So what are those critical success factors? You have financial performance, competitiveness, quality, innovation, flexibility, resource utilization. Now you don't have to go to, the note, right? When you say financial performance, now every company, guys, at the end of the day, they need profits, right? So one of the critical success factors is your financial performance. Very simple. Number two, competitiveness. Now think about PPIM. So we are competing with so many other rivals in the market. For us to survive, for us to be successful, we have to stay ahead of the competition. At least more, players in the market, right? If we fall behind, then there's no there's no way that we can move past the other rivals. People, we have to stay on par or ahead. You come second, you're always second and third and fourth, and then you're out of the picture. It's as simple as that. Yes, competitiveness. Quality of the service, people, always matter. Yes. So if you have to think of it, right, from the customer's perspective, so you're the one who's receiving the service. So how are you going to feel about the service? Will you be okay? Will you be like very satisfied? Will you be like, will you be indifferent, or will you be like, no, I'm not going to that place ever again, right? So, you have to think of it as if you're the customer. So, quality. The quality is good, brilliant. If the quality is bad, end of story, right? Quality, people. So for you to think about quality, you have to basically, think that you're the customer, right? Think of yourself as the customer, and then you look at it. Okay, am I getting a good service? No. Why? When you start asking questions, people. Yes, innovation. Obviously, all companies have to innovate, people. Otherwise, they lose out. Why do you think we are doing revision classes free of charge? Why do you think we do these classes online? Innovation, right? Um, you know, there are new platforms through which we can provide education services. There you go. This is one such platform. Yeah, online classes, live online classes. Flexibility. Okay, what's flexibility? Being able to use your resources, flexibly, right? So, as an organization, you should be able to adapt, right? You can't be fixed, right? So, Charles Darwin talked about the survival of fittest. No? That's flexibility. People, these are not new things, right? So you have to be flexible. You need to adapt to whatever the environmental changes. Yes. You have to look at what others are doing and you have to come up with a better thing. Yeah. Resource utilization. So whatever the resources that you have, make sure that you're using them to the fullest, right? Make sure that your resources are not underutilized. Make sure that you're using them the most efficient way and in the most effective way. Yeah, right. So you have to get these six rights. I'm sorry, you have to get these six factors right for you to survive and be successful, right? Okay, so for each of these dimensions, companies come up with metrics. Now we say financial performance. We have to perform well in terms of financial. How do I know that I have performed well in financial nature? You have to come up with metrics. Competitiveness. We say, okay, we have to be competitive. We have to stay ahead of the competition. How do I know that I'm like a very competitive player in the market? You have to come up with a metric that measures competitiveness. Quality, same thing. I have to come up with a metric that measures quality. Innovation, same thing. I have to come up with a metric that measures innovation, flexibility, utilization. Are we clear? Yeah. People, so these dimensions, for each of these dimensions, you have to have metrics. Are we clear? Metrics are your performance indicators. Yes. So if the financial performance is measured through, let's say, gross profit margin, and let's say you calculate the gross profit margin for the last 5 years, and you realize that gross profit margin has been coming down, financial performance is bad. Yeah. Standards. What are standards, people? Now, so we talk about dimensions and metrics, in the first, on this model, on this building block that we have on top, right? Standards. Here we talk about, basically three things: ownership, achievability, equity. Now, people, so achievability, you have to have achievable targets. You can't have like unachievable, like very high sort of targets, because if the target is very high, you get demotivated. Right? It can't be too low either. It has to be in the middle. They should be achievable, is what I'm trying to tell you. Ownership. People, give managers the accountability, responsibility to achieve these whatever targets. Give them the chance, right? Let them take ownership. Yeah, do you understand that? Right? Ownership is that let them take charge. Don't always tell them what to do. right? Let them do whatever they want. Let them take ownership. Let them take the responsibility. Yeah. So when you give more responsibility, more freedom, they get motivated. Yes. Equity is, equity is where we say, so there should be fairness, right? When evaluating the performance of the ones who are responsible for achieving these targets, right? You have to be fair, right? You can't be unjust. Rewards, people. So these people who are in charge of, like, making sure that these are achieved, they have to get some rewards, no? They have to get some, benefits. Yeah. So here, rewards are directly linked to your metrics. So reward should be clear. Everyone should be able to understand how the reward is calculated, what reward they're going to get, right? They should be able to control it, and they should be motivated to achieve that reward, people. Are we clear? That's your model in its simplest. Okay. So there you go. So here, for each of the dimensions, calculate one performance indicator for MSc and one for OSC average using data available. Briefly justify your choice of performance indicator and discuss MCS's performance relative to OCS service standards. Right. Okay, so you need to come up with a performance metric. You have to justify why you have come up with that and discuss performance. Right. Okay. So what are you looking at, people? So this is a, uh, a garage, no? They're providing, like, services for car owners. So they have 55 garages. People, you look at any country, so, the demand for vehicles, people, they buy a lot of vehicles, right? They commute in their own vehicles. You take Sri Lanka, you take any country, right? There is so much demand for vehicles, so therefore there is so much competition in this garage, automobile industry. Yeah. So that's what they're telling you here. Each service center operates autonomously. Our managers are able to choose how to package up the services they offer. So autonomously meaning each of these service centers, they have freedom to do whatever they want. OSC aim is to make the task of car maintenance pleasure and not a chore, right? Okay. National website states the following. So this is a what we call service company, a garage, right? That has outlets in 55 centers. Like, in our country, people say Toyota, right? Toyota service centers are there in Ratmalana, one is there in Vattala. You take any service, what we call service station, people, that has number of outlets. You're looking at something like that here. Range of service packs available, including express service and full valet. We work whilst you wait, with average wait times of only 2 hours. So you wait for 2 hours, you get your work, right? They finish your work. Watch our friendly, experienced mechanics producing high quality work. So they have highly skilled mechanics, right? So they produce high quality work. Freshly made tea and coffee and free internet, right? So you have loungers, right? So you can wait until they work on your car. There is tea, coffee, and free internet. What else do you need, right? Monthly free price draw for all customers completing an online feedback. Okay. Customers initially access the national website. Depending on their location, they are automatically redirected to the website of their nearest service center. Okay. Because some websites ask you, like, is it okay to track your location? So this website does something like that. They have one big website, national website, right? So it tracks your location, and then they suggest the nearest service center to you, the website of the nearest service center. So you are taken to that website. Firstly, you access the national website, right? The national website tracks your location, and they take you to that, to the website that is very near to your location. All bookings website, their website bookings, no? Result of one service center, Midland Service Center, for the year which has just ended are given below. The column headed OSC shows average figures for all OCS 55 service centers. So you're looking at one center against all the other 55 centers, like 54, no? So you take 50, you take your center. This is OSC average. You average up everything. Revenue, gross profit, number of mechanics, senior, junior, new packs developed, website hits, number of jobs booked and completed, number of jobs from repeat customers, time spent completing jobs, percentage of customer feedback. Okay. So there are notes, no? Let's go through the notes as well. Mechanics are classified as senior if they've been qualified for more than 5 years. Okay. Junior mechanics include both trainee who are unqualified and mechanics who have been qualified for less than 5 years. So you have under junior, you have like, trainee mechanics and also other mechanics who hasn't done this 5-year requirement thing, people. So for you to be categorized as a senior mechanic, you have to do 5 years. So even with a guy, even if there's a guy with 4 years and 6 months experience, he is also categorized under junior. MSc introduced 3 new packs: free valet for orders over 100, safety check costing only 20 instead of usual 40 for all customers booking a full service, a $10 air conditioning efficiency check, which usually costs 20 for all customers booking an oil change. So they have come up with 3 new services, people. Free valet, if the order is more than 100, if your service cost is more than 100, safety check for 20, and air conditioning efficiency AC check for $10. Yeah. These 3 new service packs produced revenues of 66, 58, and 54 respectively. 2 comparable new service packs developed by other centers produce 44, 42. People, so our service center has produced 3 service packs. Other service centers on average 2, no? So that way we are good. We are doing, I think we are good in that terms. If you look at the revenues, people, look at the revenues in, right? Sales revenue. So 760, 500, average is 890. We are very close, no? We are very close to the average. We are below the average, but very close. Gross profit 304. Here, average gross profit is 320. We are almost there. Number of mechanics here 7. On average, this company has 7.8 mechanics. So say we'll round it off to the nearest whole number 8. 5, 5.2, 3, 2. Number of websites hit. Website hits 14,000, 18,260. Number of jobs booked and completed. So website hits as in people. Now you go to the website, you check out whatever that's there, and then you come out, right? If you're not satisfied, you close the window, you look for something else. So out of 14,000, there have been 9,506 jobs booked and completed. That's good, right? Number of jobs from repeat customers, 1,500, right? Time spent completing jobs, 23, 24. So in this way also we are good, no? Efficiency, we are taking less hours. Customer feedback showing the scope, 80%, here 70%. So in so many ways, our service center is, I think, we are performing better than other service centers on average. Are we clear? The CEO of OSC has recently attended a business, blah, 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 Fitzgerald and Moon's building block, blah, blah, blah. Okay. Now, we need to come up with metrics. No? Right. Let's come up with a metric for financial performance. People, financial performance, you can see that they have given you gross profit and sales. Right. So you take gross profit margin. Right. So you take gross profit margin and you need to explain why you're taking gross profit margin. So why? Because gross profit margin, it measures, what do I say? How do I put it? Now, this is a service company, right? Service station. Gross profit margin looks at your direct costs, no? Right? Direct costs. So, how well you have managed your direct costs is what your GP margin is going to show you as far as this company is concerned, people, right? Direct costs. So your controllability, right? So GP margin is a good measure is what you need to say, right? Why you're taking it? Because it shows the ability, it shows the level of controllability over direct costs. And then what do you need to do? So I have calculated, uh, calculate one performance indicator for each. Calculate one, calculate. So you need to calculate gross profit margin for MSc and OSC. That can be done, right? And then you have to discuss it, right? Based on the numbers, you need to talk about it. Are we clear? Right. Competitiveness. So how competitive you are. People, how do we measure that? How do we measure that? How competitive you are. Now they say this market is highly competitive. So a lot of people are accessing, the web to look at service stations, and they are making, reservations online. So you can look at number of hits now. Number of website hits 14,000. Out of 14,000, you have done now 9,500. So you can take that as your competitive, metric now, right? It shows you, you know, how do I explain that, people? So, a lot of people visit your website, right? 14,000 people have visited. Out of that, 9,500 has, actually booked and gotten the service. So that shows, you know, um, uh, 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 it shows. Now, if the percentage is very high, that means you're like, you know, you're somewhat competitive, right? So a lot of people are coming to you. Does that make sense, people? Yeah. So total number of jobs divided by website hits is going to tell you your competitiveness more or less, right? Uh, quality, quality, quality. How do we measure that, people? Or we can talk about repeat customers, right? Now, number of jobs from repeat customers. So out of total jobs, repeat customers, so they come to get their car serviced again because of the quality. People, you go visit another place, right? To buy whatever, mainly because of the quality, right? Now, supermarket and all that, people, you go there just because, it might be somewhat easy for you to access, like, convenience, less distance. But something like this, people, right? You get your vehicle serviced by a low quality garage, you never go there again, right? You don't, because you love your vehicle, right? You don't want to get it serviced by a low quality service station, right? So, repeat customers against the total number of jobs, that is going to give you some idea about quality. So you need to calculate that for MSc and OSC and talk about the numbers. Yeah. So why are you taking it? So repeat customers, they come only if the quality is high, only if they are satisfied with the quality, right? If not, they go find other suppliers in the market, other service stations in the market. Done. Innovation, quality, innovation. People, innovation. People, we can talk about these revenues, no? So revenue from the innovations have been 66, 58, 54. Out of total revenue, you can add these three up and take the percentage, no? Right? So here they have average sales revenue. You can take these two, add them up, and take that as a percentage of this value. You get your, whatever innovation measure for the rest of the company. Yeah, uh, innovation. So you have come up with new packs. How many? Three new packs, and these are the revenues. Out of total, how much revenue are you getting from new packs? So that tells you innovation, that talks about innovation, right? Uh, flexibility. Flexibility. What do we talk about flexibility, people? Resource utilization. Resource utilization, you can talk about this time spent completing jobs. No? So you can take the average number of hours per job. So total jobs 9,506. Total time spent for all the jobs 23,100 hours. So you take the average hours, people. Divide 2,300 by 9,506. Do that. Do the same thing for OSC average. You take, you're looking at your efficiency. You're looking at your efficiency, right? Right? Resource utilization. Resource utilization. Yeah, you can take that, no? Flexibility. What can you take as flexibility? Flexibility. Any suggestions? People, flexibility. Flexibility. What can we take? Hmm, time spent. Flexibility. So resource utilization, I think you can take this, time spent, right? The efficiency, flexibility. Flexibility, people. Any idea? Flexibility. Nothing comes into my mind. Flexibility. Okay, you know what? Now I've come up with measures for all these other, like, five aspects now, five dimensions. Why don't you come up with a metric for flexibility? Maybe if you can read what flexibility means, you can understand. Okay, I'm getting an answer. Let's see. While they work, yeah, yeah, they can, yeah, sit and drink coffee and browse the internet and wait like jackasses. No, yes, yes, they can. Yes. How do we flexibility? In what sense are you, flexible in when you say that you can, like, drink coffee and wait? What do you mean? We work whilst you wait. That one. Average work times only 2 hours. Okay. You know what, guys? You know why? Yeah, let's say customers don't have to go. Okay, okay. Flexibility. That's not a good measure, no, man. Flexibility. Oh. Flexibility, resource utilization. So they say you can get your vehicle in 2 hours. Now you calculate the average number of hours per job. Is that flexibility? Is that flexibility? Hmm? So they have, less mechanics. No, look at the mechanics. Will you now? I'm looking at the mechanics. Here 7.8. That's like 8. No, 8, 5, 13. Here they have only 12. So resource utilization. So can you talk about the number of mechanics, right? So resource utilization, guys. I think time spent per job, resource utilization. Yeah, I think for resource utilization, you can take these the number of and these people have more mechanics and they have taken more hours. No, these people have less mechanics, they have taken less hours. So that means we are utilizing our resources to the fullest. Yeah, right. I think you can use that for your resource utilization, people. Flexibility. You know what? I think I've explained enough. Why don't you come up with a measure, people? Don't look at the don't look at the answers. Huh? Just coming up with measures as I'm reading, people. Right? Okay. Part B. Explain how standards and reward blocks support dimension. I just explained that. Yeah. I just explained that, people. Okay. Earlier, I explained that part. So, guys, now we have looked at three questions, three solid questions, right? I explained a hell of a lot, right? Purpose of this revision is not to just, discuss answers, but also to refresh your memory. So I looked at the relevant theory areas as well. Okay. So, now if my discussion didn't get registered in your head, that's completely fine, right? Tomorrow, if you have some free time, take 1 hour, right, and do the question. Now, people, into the next 2 weeks, right? So some of you might be working, some of you might not be, especially the people who are working, right? So if you can take leave, brilliant. Take leave and study, right? Don't worry about your jobs, people. They're not going to miss you, right? Uh, take sick leaves. Get sick, right? Get sick. Suddenly get sick. And be like, okay, I can't come to work for the next couple of days. And then you study. Sit on your ass, right? For 7, 8 hours, you study like there is no tomorrow, people. Yeah. Okay. So now to streamline this, efficiency, people, what I want you to do is this. Now only like 2 weeks now. Yeah. Don't take a lot of time to answer the question, right? Take 1 hour, 1 hour, 1 hour maximum to answer section C questions. 1 hour max. You do whatever that you can within that 1 hour and then stop, right? Take a small break and then look at the answer. Yeah. See how far, to what extent you have come up with the answers. Yeah. Don't take, a lot of time because it's a waste of time, people. Yeah, but if you have time, right, that's okay. Come up with good answers within, take 1.5 hours, right, into the next couple of days, right? Take 1.5 hours, answer like three questions, right? 1.5 each, right? You do one in the morning, one in the noon, and one in the evening, right? That's enough. Okay, and here and there you do section B, section C questions as well. Focus more on section C, right? Type answers, do the workings. get the hang of doing things fast, people. Okay, that's why I give you 20 minutes. That's not enough, I know that, but you have to learn, no, at some point, yes. Okay, time it and do it, people. Okay, but if you are not very comfortable with the area, right, take more time and then cover that area with one or two questions, right? Advanced variances, transfer pricing. Look at basic questions. Try to do them on your own. Try to do the MCQs. Yeah. So we only have two other areas to look at in your syllabus, people, that I will discuss in the next week. Okay. Any questions before we wind up for the day? Any questions? Anything, people? Any questions? No? I've taken, usually people, I always drag the class. That's my thing, right? I never finish on time. I drag the class. But what to do, people? I'm doing that for you, right? I actually did not come up with an example, Abdul. I want you to, okay, now this flexibility, I'm having a bit of a, gray memory, right? I can't remember what flexibility means. I can't remember what it means. The full idea is not there in my head. So I want you to check the flexibility, the note, right? Whatever that you have, and then come up with a ratio. Try to do that on your own. Okay, right. Remember, people, now here you have only limited information. So, the ratios, whatever that you come up with has to be somewhat practical. As long as they're practical, you get marks. But because you have limited information, your answer should be very equal to the examiner's answer, right? Now, people, please understand the examiner's answer is, in some cases, will not be the same as your answer, but you still get marks. You understand that? Because ACC, unlike your degree and all these other academic papers, professional, right? Meaning practical. You can come up with practical answers, people. What they test is your practicality. Yeah, not theory. Okay. So what do you need to do? Questions and answer. Questions and answer. Focus more on section C. Time your answers. Maximum 1.5 hours. That's it. Right? You take a break and then look at the answer. Finish it off then and there. Focus more on the areas that you're not very comfortable with. If you're okay with ABC, life cycle costing, don't look at them. Right? Look at them 3 days, 4 days before the exam. If you're not okay with shadow pricing, linear programming, break even, do them now. Right? Look at one or two questions to refresh your memory. That's it. It's all there in your head, people. You need to give it a small spark, right? Small, kickstart. Okay, it's all there. Have that confidence, people. Try to write the answers within that 1.5 hours. Show the workings, whatever that you can, clearly in a way that your examiner can understand. Yeah. Okay. Clear working is very, very important, people. Very, very important. Leave lines. Yeah. Leave lines, show you're working very clearly, right? And don't worry about spelling mistakes and all that, people. Yeah, that's not a big deal at all. Okay, right. Brief points, number of points. Yeah, when you tackle theory questions in section C, right? Number of points with small explanations. Break your answer into small paragraphs, short sentences, not long, short. Okay, don't write long as sentences because Britishers don't like long sentences, people. Yeah, when you write long sentences, you start putting all kinds of things, people. What you start and where you end, they become completely independent of one another, people. Right? Meaning you will not know head or tail when you finish this sentence, people. Yeah. So short sentences. Yeah. Right. Okay. So with that, we'll finish for today, people. Hope you learned something out of this session. Right. I'm very sorry I dragged the class by half an hour, but what to do? It's for you, not for me. right? I'll see you guys on Monday then. Monday, the plan is to look at 2 questions on variance analysis, 2 from transcribing. Okay? Right. Thank you, people. Have a good night. Right. Okay. No problem. Bye. Good night.